We don't just build wealth, we build legacy. Welcome to the Retirement Income for Life show with Doug Vincent. For over 30 years, Doug has helped families right here in the DC area turn hard work into lasting income, helping you protect what you've earned, provide for your family, and retire on your terms. This is where preparation meets opportunity. This is the Retirement Income for Life show. Here's Doug Vincent.
Annuities demystified. Clarity, confidence, and cash flow in retirement. How to understand the products, avoid the pitfalls, and unlock guaranteed income that lasts a lifetime. Welcome to the show, and shout out as always to our DMV listeners, Washington, D.C., Maryland, Virginia. Thank you for tuning in. And thank you for scheduling those complimentary consultations. We're here to help with any financial situation for you, your family, your business at no obligation. Also, continue to join us for our podcast, subscribe and listen to this episode and others on our YouTube channel, Retirement Income for Life. And once again, just don't hesitate to reach out to us in this current environment, which is unpredictable, and we're helping people with their retirement income for life every day. Doesn't happen by accident. And so one of the things we're going to talk about today is building steady income. Okay, dependable income streams that let you enjoy your retirement without second guessing every headline. Okay, we want to make sure that you have predictable income no matter what the market's doing. No matter what your situation is, predictable income can provide a lot of confidence, clarity, peace of mind, right? Always, you can reach us locally here at 301-242-3950. Also, our website is www.retirementincomethenumber4life.com. We look forward to helping you with all of your retirement planning needs. All right. So an overview for today's show. We're going to really dig into annuities, the role of annuities today, what they are, what they aren't. Annuities are no longer old fashioned. They're no longer one size fits all. So we've got to go over those pros, those cons, different things, different definitions of MYGA and FIA and fixed and variable. We're going to break down all the major types of annuities, going to give you that in plain English, and explain who they're best suited for, and in some cases, who they're not suited for. All right. Also, we'll talk about how annuities protect you from market volatility, and they buffer you from, those market downturns. We want to look at some case studies. Okay. 2 retirees, 2 different outcomes. We're going to compare the all in the market versus some of your money out of the market that might include a fixed index annuity. So it's a good case study that we'll walk through. Then also answering some of those common questions about what's right, what's wrong. We want to separate fact from fiction and answer these most common questions retirees are always asking about annuities. Okay. And finally, we will wrap up today's show talking about your vision for retirement, those things you need to be considering, especially if you're retiring this year, or if in the next 1 to 5 years, you need to ask yourself a number of questions and, prepare yourself wisely for your retirement. Okay. The financial wisdom quote of the week comes from Jane Austen. And Jane Austen says, people always live forever. People always live forever when their annuity there's an annuity to be paid for them. I can't even get that out. Let me say it again. People always live forever when there's an annuity to be paid them. Wow. What does that mean? Well, thank you, Jane. And we're going to jump into a lot of that particular quote of the week, that financial wisdom. We're going to talk all about that today so that you understand exactly what that means. All right. The role of annuities today. Okay. Annuities once had the reputation of being your grandfather's retirement tool, right? That's that, thought of as old fashioned. Okay. Now, today, once this was thought of as being, predictable income, that's outdated, right? We need to be in the market. Annuities today are one of the most in demand, watch this, ways to balance that security and that flexibility in retirement. You need security in retirement. You need flexibility in retirement. Annuities, a lot of times, can balance that out. Okay. So what's bringing annuities today back in style? Okay. How has the retirement landscape changed? I'm glad you asked. Well, number one, pensions are disappearing. Think about it right now. You're listening to me as you prepare to retire. Is a pension being replaced with a 401k or a 401k match, or maybe you don't have anything at all? Okay. But what we see is that long-time pension that a lot of our parents, grandparents utilized is disappearing. So pensions are disappearing. Number two, Social Security faces long-term uncertainty. You hear it all the time. Social Security is not going to be around, or Social Security is going to be reduced, or the Social Security pot of funds is running out. So they're back in style. Annuities are back in style, number one, because pensions are disappearing and there's a lot of uncertainty with Social Security. And then finally, market volatility feels like the new norm. The stock market up 20%, the stock market down 20%. You have no idea from one day to the next how this market is going to react. And so retirees often ask, how can I create my own pension-like income stream? Let me say that again. Retirees are trying to figure this out. We're doing it in my office every day, but they're trying to figure out, how do I create my own pension-like income stream? Okay, so let's look at some statistics. Okay, LIMRA, they're projecting that 400 plus billion in annuity sales as they look back on 2025. There was a record high of $400 billion in annuity sales. Okay, now why do you think that would be? Because once again, pension is going away, Social Security uncertainty, and we don't know if that $1 million in the stock market is going to be 500,000 one day or 800 the next day. So 400 billion in 2025, a record high number, went into annuities last year. Also, they're younger buyers, not just grandpa. Okay, so retirees or pre-retirees or mid-career professionals in their 40s and 50s, they're jumping into annuities to lock in these guarantees earlier. Okay, this is very important that you look at your portfolio and you want to diversify as it meets your, the different risk tolerance that you have, right? Another reason why is the products are very innovative now. Okay, the modern annuity products are no longer cookie cutter. There's so many variations that you can look into related to flexible, withdrawal options, inflation protection riders, long-term care add-ons, right? Legacy planning. The mom and pop annuity is no longer in existence the way that our grandparents looked at them. These products are very innovative and they're providing real value for a number of Americans. 400 billion in annuities in 2025. I'm curious to see what that'll be this year. I believe it'll be higher, but the real value for annuities is peace of mind. Research shows retirees with guaranteed income streams from annuities or pensions have a higher level of peace of mind. Okay. They know where the money's coming from, right? They know how to set their budget, These stats are saying that annuity or pension holders and retirement are, retiring a lot happier. In retirement, they're a lot happier. They don't have to stress about the volatility in the market, and they are experiencing a lot lower levels of financial stress than the peers that they're talking to. Okay, you're sitting and you're talking at your community center or after you finish playing golf or at your church, wherever it might be. And your friends stressing out because they don't have annuities or they don't have a pension. All they have is Social Security and maybe a good 401k. And so think of annuities as the foundation of your financial house. Okay. Market investments equal walls and windows, and they add value and variety. Annuity income equals the concrete base. Okay. Sturdy, predictable. It keeps the house upright. Let me say that again. The annuity is the financial foundation of the house. Okay. That's the concrete base. That's that income, that predictable income provides that sturdiness and keeps that house upright. But once again, we don't want all of the money out of the market. We do want a hedge against cost of living and inflation. And that's your walls. That's your windows, right? It adds value and there's a variety, but it does not act as that firm foundation. So if you're wondering if your retirement could use that strong foundation, let's talk about how an annuity might fit into your overall plan. Okay. How might an annuity be a part of that foundation that you need that, you don't have a pension, or you do have a pension, but you want more guaranteed income? Give us a call, 301-242-3950. Get on our calendar, on our website, register for 100% free consultation. Is complimentary at retirementincome4life.com. At our website as well, we do have a retirement income for life survival kit. You can download that absolutely free. We've put that together to basically package up a number of modules for you to begin this process of your retirement income for life journey. All right. So let's do some defining of some of these different annuity types and all the innovation that is taking place in our market today. And we want to define what a MYGA is, a MYGA. We want to define what a FIA is, a fixed index annuity. And we want to define fixed annuities and variable annuities. Okay. At this day and age, with all this innovation, it can seem like alphabet soup. And with all these different titles, all these different names, I'm going to give you that cheat sheet today, and we're going to talk about exactly what they are. So if you had a fixed annuity, just plain and simple fixed annuity, that's going to give you a steady guaranteed interest rate. Okay, that's going to vary from contract to contract, but it's going to be a fixed rate of return each and every year, steady and guaranteed. That's going to be one of those simple, predictable amounts. So think about like a fixed index and think about a fixed annuity, like a CD alternative. Think about a CD. Now think about a fixed annuity. That would be your CD alternative. All right. Now let's go into the second one. Now, a variable annuity. This is invested in market sub-accounts. So you are in a position now to receive the upside, the growth of the market, while also knowing that you should expect it to go down as well. The up and down, the volatility of the market is within a variable annuity, but you get the best of, you get sub accounts that you can invest in along with the annuity components. And that's how a variable annuity is going to work. Now, a multi-year guaranteed annuity, or your MYGA, is you lock in a set rate for several years. Okay, this rate is often today, let's say 5 or 6% in today's market, and this is something that is a multi-year guarantee. Might be 3 years, 5 years, 7 years, something like that, and it's great for people who want that stability with a defined term. The variable account is going to be up and down, whereas the guaranteed multi-year is going to be fixed, but for a longer period of time that you can guarantee that income will be there and that growth will be there. Now, the fixed index annuity, or FIA, that principal is protected. Okay, so just think about the movement into an FIA as you've moved your money out of the market into an account where you could not lose your principal. Right now, the gains are tied to an index, something like one index I could mention that you're probably familiar with is the S&P 500. So principal protected, your gains are tied to the index, and the advantage here, and in some cases people feel like a disadvantage, is for that principal protection, for that insurance from the company that you're working with the FIA. You share in the market upside. So for instance, this is in general, the index went up 10%, you made 5, the company made 5, right? There's caps, there's participation rates that are tied to these. And so there are variables on how you structure a FIA, but you can guarantee that your principal is protected while you share in the gains with the company that you're working with. Okay, so the key here is, with all this innovation, all these different types of annuities that are in the market today, is that you match the right product with the right person. Okay, the annuities that you might be attracted to are unique to you. Okay, you might be conservative, you might be risk averse. Okay, that would mean you're looking for a fixed or maybe a MYGA, right? You're more of a moderate. Let's say, you can balance out the ups and the downs. You want growth, but I also want protection. That's where the FIA comes in. Okay, your fixed index annuity. Now, if you're comfortable with market risk, okay, you got a long-term horizon, okay, a variable annuity would possibly, fit the type of person that you are. So the thing that trips people up a lot of times is, hey, why do I have to share in the, gains? They have my money and now they've capped me at a certain amount, or my participation rate, I don't like that. Well, your principal was protected. So how the company is going to make money for giving you that guarantee is a share with you in those gains. And so it's up to you then to, as a part of your diversified portfolio, understand the possibilities of, okay, hey, if I have a 9.25 cap here and the market went up 20%, hey, I made 9.25%, which far exceeds cost of living and inflation, and my money has gone up by 9.25%, just give me an example, with no risk of my principal going down. Okay, so you have to fully dig into the pros and the cons. Why would I do this? Why wouldn't I do this? Okay, some people like short-term surrender periods. Okay, whereas an annuity might allow you to, for the long term, stay with that contract for 14, 15 years. Okay, whereas they have them as surrender periods as low as 1 year. Okay, so you want to know the time frame that you want to have this annuity and not get tripped up, by a time frame. Also, there are a number of riders, okay, that are attached to the contracts that most of the time, some of those riders are going to cost you a fee. In other cases, let's say for a death benefit or, something of the like, it may not be a rider fee. Whereas if you needed a long-term care rider or an inflation rider or an income rider, that might cost you an annual fee. And you need to understand the pros and the cons of why I would want to pay that fee to get that rider, get that benefit, on top of the annuity that I chose. So these details, which you have to look into them, and this is going to frustrate you or bless you. Okay. If you don't have someone that can really dig in with who you are personally, what your goals are, you can really be frustrated. But we have a lot of people that are really feel blessed by the annuities, by, they've talked it through, they understood it. And watch this. The other good thing about walking through an annuity analysis is you can determine whether it fits you or not. You can take all the chips off the table and leave your money in the market, never do an annuity once you fully understand them. But what I find oftentimes is most people don't fully understand the options and might be conservative or, moderate and really want that protection, but didn't understand that annuity, was right for them. So just don't learn the product acronyms, learn the timelines, right? If you need money within 5 to 7 years, avoid annuities that have long, surrender charges. Okay. If you're going to need to take big amounts out, from these annuities early on, then you're going to want to have this as a short-term, surrender period, even though you don't have to end the contract, but the surrender period ends early and you're able to, take more out. In a lot of cases, you can take out a percentage each year after the first year in a lot of cases. And in some cases, even in the first year, that it provides supplemental income, doesn't disrupt the contract, doesn't cost surrender charges. And now it becomes just a part of an overall four-legged stool, if I could say that, where now you're getting money from the first leg, which is your pension. Second leg is your Social Security. Third leg may be from your 401k. Fourth leg may be your annuity. Okay. And hopefully we can get another leg in there as well. But the bottom line is you don't want to be confused by these annuity acronyms. You don't need to memorize them and try to do this on your own. As I say all the time, give us a call, 301-242-3950. Set up your annuity analysis, your retirement consultation right there at our website. You can log in at www.retirementincome4life.com, and we'll walk through all those specifics with you so that you don't have any confusion as to whether annuities are good for your portfolio. All right, so let's shift gears here and let's look at the basics of an FIA, the basics of a fixed index annuity. Okay, and not too risky, not too boring, but just right. Okay, it's not too risky, it's not too boring, but just right. Let's see how they work. So you invest a lump sum. Okay, it's going to be a single premium investment. For the most part, that principal is guaranteed. So what does a guarantee mean? You won't lose money when the market falls. Okay, it's right there in the contract. Protected principal. You do not lose money if the market turns against you, right? The earnings are going to be tied to an index, okay? An index such as the S&P 500, right? And now your growth, and this is why the research is important, is going to be connected to what is my caps, right? What's my maximum percentage of index gain that I could earn, okay? What's my percentage participation rate, okay? How much of the index gains do I share in? Okay, how am I participating within this contract? Those are going to vary. Okay, they're going to vary based on risk. They're going to vary based on economic conditions, and if the market drops below, let's say you had a negative year in the market in that index, guess what happens? You didn't earn anything, but you didn't lose anything. You would not have negative returns. Okay, you earned zero for that period, but you don't have negative returns. How does that sound? For a lot of people, they want the satisfaction of having an investment to where I know my principal's protected, but I also want to have the opportunity to do better than banking instruments. I want to also have the opportunity to compete with the stock market while having that risk taken off the table. That's why we say it's not too busy, or I'm sorry, it's not too risky, but it's not too boring. Okay, these are FIAs are a lot of times right there in the sweet spot. So why do they appeal? You sleep well at night. Okay, no 20% losses that you can see happening because the market now is in a bear market. Okay, and hey, the market went down 20% and now your portfolio was $1 million, now it's 800,000. Okay, you can sleep well at night and know that the money that has been moved into an FIA is 100% protected. Secondly, you have optional income riders that guarantee a lifetime paycheck. You can have a rider that can begin to send you a lifetime paycheck, just like Social Security, just like a pension. You've now customized this as your own pension plan. And then finally, one of the appealing things is you can customize these as an inflation protection hedge, right? You can put in there legacy riders, or how you want the money to be given to your beneficiaries. There's flexible payouts that could be set up. Okay. And so let's look at an example. And, two retirees, let's take two retirees that invested $200K each in an FIA in 2014. This was during the COVID crash. The stock market dropped 30%. Okay. And now that's 6 years later from when they put that money in there, and their FI didn't lose a dime, and they've captured partial rebounds when the market recovered. Okay. You captured market rebounds when that market went down COVID down 35-40% in some cases. All right. Now that's an example of a good thing. Now a drawback. Now, more complex than traditional fixed annuities, just a standard guarantee, right? There's typically gonna be surrender charges if you withdraw too soon. Okay. If I'm gonna give you 100% principal protection as a part of the analysis and setting this up, and why it's not a drawback for anybody that works with me, is because we're not gonna put money in a place to where you're gonna need to now give back some of the returns or give back some principal because now you're subject to surrender charges. Okay, that money needs to be planned in other places. Okay, the growth is capped. That could be a drawback, and you'll never get all the market, upside. But that's only a drawback if you haven't done diversified planning, because we want market upside in another place. But when that volatility kicks in, you've got your FIA in place to where now that principal didn't go down. You see why this has to be a balanced approach. Retirement income for life has to be something that you do planning around. Annuities take a very, very important place there. And FIAs, they're not about chasing the hottest returns. They're about creating a steady middle lane on the retirement highway, right? Market upside when it's there, principal protection when it's not. Okay, so think of an FIA as the middle ground between too risky and too safe. Okay, starting with working with us today, one of the things that you can do is, as I said, set up a free consultation. Okay, start working with us. And this is something that we can do a full portfolio analysis on. We take a hands-on approach on working with our clients, making sure that it's about your goals, your vision for retirement. Okay, we examine your current plan, your portfolio of assets. We walk through, the things that you've already put in place, the things that you want to put in place, and then we begin to map out a game plan. We'll make some recommendations for you. We answer all your questions about, what you want your retirement to look like. All of this is done 100% free. It's a consultation that we do, 15, 20 times a week. Reach out to us, get started with a customized retirement plan today. Just go to our website, www.retirementincome4life.com. You can call us 301-242-3950. This is a no obligation consultation. Let's understand multi-year guaranteed annuities, right? MYGA. MYGA. Let's understand what a multi-year guaranteed annuity is. And this is the simplest way to lock in steady growth without worrying about the market. Okay, market volatility can trigger knee-jerk decisions, that you may feel real smart for the moment, but now it's costing you, in the long run. Okay, so how do these multi-year guaranteed annuities work? So you invest a lump sum, okay, and you set that number for the number of years you want that guarantee. 3, 5, 7, 10 are familiar time frames where MYGAs are set up, and the insurer guarantees a fixed interest rate for that entire period. Okay, at maturity, you can take withdrawals. Okay, so on a yearly basis, if you want to take money out, you are able to do that. At the end of the term, you're able to do that. You renew for new terms, and you can also annuitize for a lifetime. Okay, you get a fixed rate of return, a fixed period. When it matures, you take withdrawals. You can renew for another term, or you can annuitize for life. Okay, why is this appealing? Predictable growth. Okay, you may like the interest rate that's attached to these guarantees over the course of those 3, 5, 7, 10 years, right? You can predict what you're going to earn year after year. right now, some of those attractive rates over, 5, 7, 10-year period are 5 to 6%, and as you compare that to a CD, you're going to like that percentage, better. And so that's one of the appealing things for the MYGA. Simple structure, no caps, no participation rates, no moving parts, guaranteed fixed rate of return. You know what it is. It's cut and dry, right? It's for the short to midterm time frame, works well for retirees who want growth but need access in that 3, 5, 10-year period. So let's give you an example. So Jane, she invested $100,000 in a 7-year MYGA at 5.5%. Okay. After 7 years, she earned $42,000 in guaranteed interest. Okay. No market risk, no surprises. And if you compare that to a CD, let's say that's on average 3%, she's going to come out, in this case, in her case, $20,000 more. Okay. Now, what's the drawback? Early withdrawals. If you didn't wait to 7 years, Jane, the early withdrawals that could trigger a surrender charge. Okay. You agree to a certain period. This is why all the money does not need to be there. If you needed it earlier, it needs to be taken from, other places. And so this money, you got to know it's going to be tied up. That conversation needs to be had, right? And if that's not the best option, to tie $100,000 in this case into that fixed period, then you're not going to want the MYGA. You're going to have to go another direction. Also, it's limited upside. Okay. There's no market participation. It's 5%, 6%, or wherever that might be. And for you, that's, more moderate aggressive, more of an aggressive investor, that might not be appealing to you because you like the volatility. All right. So here's some key takeaways. MYGAs are about certainty and simplicity. It's very straightforward, and they're best for people who don't want surprises, are comfortable with a solid guaranteed rate of return. For the most part, in my view, if you're going to look into a MYGA, make sure it exceeds cost of living and inflation. Okay. You're going to need to make sure that you're somewhere in that, in my view, somewhere in that 6, 7, 8% range, because you're going to have to commit to leaving this money untouched. But when that money frees up and you've gotten that rate of return, now you're going to need that money to have kept up with inflation and cost of living, because 7 years later, the cost of living, cost of goods and services is going to be higher. Okay. So got to take that into consideration. And, always, just a quick tip, know the surrender schedule and how that schedule fits into your, the flexibility you need related to withdrawing money or allowing money to stay where it is. Give us a call, 301-242-3950. Go to our website, set up a free consultation. We can discuss MYGAs with you at Retirement Income, the number 4, LIFE.com. All right. So how annuities protect you from market volatility? How do annuities protect you from market volatility? Think about annuities acting like those shock absorbers, right? This smooths out the ride while the market is swinging. While the market volatility is going up like a roller coaster, your annuity is providing those shock absorbers, right? So market, swings, it feels like you got whiplash sometimes. 1 week your portfolio is soaring, next week is slipping, real fast. And for retirees who depend upon that steady income, they don't want the volatility a lot of times. They don't want that stress. This can be dangerous, right? And, annuities, I might run out of money if I'm not careful. A lot of retirees are saying it. So annuities can help in a lot of cases smooth out the ride. Okay. So here are some things to just consider. And we touched on them a little bit earlier, but annuities provide stability. Why? How can you say annuities provide stability? Whereas guaranteed income, okay? You want guaranteed income, annuity can, cover the essential expenses, regardless of how the market performs. This amount's coming in, you can set up guaranteed income. Along with that, principal protection, okay? So you don't have to worry about waking up one day, the market went down 30% and your portfolio is now 30% lower. No, the principal is protected along with the guaranteed income, and you can diversify into how you want to balance out who you are as a person And is it, hey, do I have a stock heavy portfolio over here with a portion of my money? And now I can go over here and put this portion of my money in an annuity that has more, guarantees and protection. You really can balance it out while that diversity is put in place. This reduces that stress we've been talking about. Okay. Retirees, the last thing you need in retirement is to be stressed out because you don't know if your income is going to be secure. Then you start panic selling. Okay. The market went down 25%. You did have $1 million. Now you got 750 and now you sell everything. Right. And then in 45 days, the market turned around and if you hadn't done anything, your account would have been $1,000,001. And so now you really stressed out now. Okay. So these type of mechanisms, the diversification needs to be put in place. So the money that you do keep in the market, you don't have to stress about. You can allow the market volatility to ride its course while you don't change your lifestyle because you have the other guaranteed income tools like the annuities in place. All right. Here's what the headlines are saying. Okay. For quarter number 2 in 2025, annuity sales were 116.6 billion. Okay. That was the second quarter of 2025. And this was the highest quarterly total ever. Now, we've just come out of Q2 2026. And if I was a betting man, I bet you that number is going to be higher. Stay tuned. We'll have those statistics soon and I'll be able to report that to you, right? More employers are adding annuities to workplace retirement plans, and they're embedding that protection at the core of people's retirement savings. Okay. Annuities don't eliminate risk 100%. They help you manage it, right? Giving you that steady income. It reduces the resilience, that you have to have, with your money in the market. And it keeps you from making those costly emotional decisions. You don't want to be at the roller coaster ride whim of the stock market. The stock market goes up and it goes down, and it's very hard to predict the market. Okay. Build out a retirement plan that can help you with steady income, help you ride out the market volatility, help you do all the things that you're going to need to sleep well in retirement. All right. 301-242-3950. Get in touch with us. Go to our website, schedule, get on our calendar through Calendly. We do Zoom meetings. We do in-person meetings right here in Greenbelt, Maryland, work in all the states. You can, be helped free of charge right on Zoom or in our local office. So let's look at a quick case study of 2 retirees, and here's 2 outcomes from them. You want to look at some differences and, see how you might fall in these categories. And I want you to meet Mark, and I want you to meet Linda. So Mark invests everything in the stock market. Okay. He loves the growth potential. He ignored all the risk. I don't care. I'm keeping the money in the market. All right. Linda, she split her savings between the market and the stock market equities and a fixed index annuity. And why? Because she wants growth. She wants that upside, but she also wants that protection. Okay. So when the market drops, 25%, in Mark's portfolio, it plummeted. Okay. And, he's taking money out. So withdrawals are now being taken. So he already started his withdrawal plan in retirement. So he's getting supplemental income from a portfolio that's 100% in the stock market. And so now he's not only still taking out withdrawals, but he's taking it from a shrinking balance, right? So now his confidence is shot. Okay. Mark's not a financial advisor. He's a retiree that wanted to keep taking risks because his accumulation strategy that he had in place before he retired, he just kept seeing this money go up. He continued to get matching from his employer. He kept putting money in, and he just believed this ride was just going to continue, even when now he shifted to stage 2, an income plan. Okay. Accumulation strategies and income strategies are 2 different things. And so his confidence plummeted and his long-term plan is now derailed. Okay. Now let's take a look at Linda. Linda, she had, when her equity portion fell, remember she had some in the market as well. her fixed index annuity, it held steady, right? Her withdrawals then, watch this, came from the protected funds. That's where she's taking her withdrawals because the market's down. You don't want to be drawing 5, 6, 7% out of a account that just went down 25%, right? And so for Linda, it keeps income intact and it avoids the panicking while the market goes down. Her decisions don't have to be impulsive or emotional, or she doesn't have to panic now because the plan was in place already before the volatility set in. Okay. Confidence still intact, clarity still intact, nothing is derailed. Okay. So now what's happening to Mark during the recovery, right? During the recovery, his account is struggling to rebuild. What if this account took 3 years to get back to even? Okay. Now you're still taking her on withdrawals, right? And in a lot of cases, because that account has to recover from losses, you take a look at it. And so now you got to take out less money because you know, people are living longer. And so you retire at 65 or 70 or 60, and you want this money to last 30 years, but you did some analysis, it's going to run out in 14. Okay. You struggle to rebuild when you're taking money out at the same rate you were taking it out when it was 25% higher. Okay. You cannot expect the market challenges that you're going to have to absorb while you're taking that money out to be sustainable, right? So the FIA, it's going to keep providing that reliable income during the recovery. This is what happened with Linda, right? The equity side, you know, it's going to rebound eventually, and that portfolio is going to regain strength, but we don't want to be taking the money out during that time. Okay, so let me give you some research, right? 61% of advisors report using annuities to help clients manage market risk. That's 6 out of 10. Okay, as a diversified portfolio, as a good advisor, you should be exploring all the different retirement tools for your clients. Okay, it doesn't mean you have to do it, but it should be explored. Okay, so number 2, retirees with guaranteed income streams are less likely to panic sell during downturns. Okay, don't gotta panic. You know, I know it's going to recover. I'm taking money out of my fixed index annuity or other places that I've already earmarked to not touch. You know, I don't want to touch the money in the market, but I've already earmarked other places where money is going to come out. And studies show that, you know, they report this is reported that there's higher retirement confidence when a person has taken this risk off the table compared to those people in retirement that don't have these guarantees, right? The same dollar amount can lead to two different retirements, okay? Linda and Mark had the same amount of money in retirement, and they're experiencing now 2 different outcomes, right? Adding that annuity for Linda because it was the right decision. It was the right planning tool, right? Gave her a mix of steady income, less stress, and a stronger long-term outcome. Okay. This is the Retirement Income for Life show. Okay. We don't want you running out of money, you know, when you get into your late 70s and 80s. Okay. So you're still unsure about this. You know, you don't know what's a fact. You don't know what's fiction. Okay. When it comes to annuities, you got to work these things out. You got to go through all of the scenarios. And as we say all the time, give us a call. We're doing these consultations every day in my office, Monday through Friday, right here in Greenbelt, Maryland. You can jump on Zoom, come in, to see us in person. RetirementIncomeForLife.com. Just log in and set that up. And we'd be happy to assist you. Okay, let's run through some of these right or wrong common annuity questions that we hear all the time, you know, myths, you know, buzzwords, you know, stuff that we hear all the time, and they're easily answered. And here's one, you know, these annuities are too expensive. Okay. My expense ratio in annuities, I'm paying too much for them. Wrong. Okay. That's wrong. Okay. Now, variable annuities. Okay. Yeah. That can carry fees of up to, you know, in general, 3%. But MYGAs and FIAs often cost little to nothing unless you add the riders. I just mentioned it to you. Unless you're adding on riders, that would be a fee. No riders, no fees. Okay, so that's a myth. Number two, annuities lock your money up forever. No, most contracts are going to vary as short as 3 years, let's say up to 10 years, right? After that, 100% of your money is accessible, although during that period of time, with a good plan, the money that you wanted to take out yearly didn't push you into any surrender charges. And you just allocated a supplemental amount while you were still in that surrender period, while you were in that so-called locked period. You're still taking penalty for free withdrawals, and it's not costing you a dime. All right. Number three, many annuities can act as a buffer against inflation. Yes, many annuities act as the buffer against inflation that you are looking for, right? Particularly fixed index annuities with inflation riders, or even variable annuities in certain, situations, that have these different income features. It can help buffer against inflation by offering growth tied to market performance, or cost of living adjustments that we've dug into. And however, not all annuities include these protections, so it just depends upon the specific products. All right, annuities are too complicated to bother with. Wrong. We've dug into a lot of the complexities today. We can dig in more if you want to talk personally. The fine print is what matters. Professional guidance is what you need. Annuities can be understood in very, very simple terms. The complexities that I've seen over all these years, they never outweigh the benefits. All right. Number five, here's something else. Annuities can help me balance growth potential with protection and guarantees. Absolutely correct. Okay. While annuities often emphasize protection and guaranteed income, many types, like the fixed index annuities we've been talking about, variable annuities, they still offer that growth potential. Yes, we're going to have some caps we're going to have to deal with in a lot of cases. The participation rates, there's different trade-offs to why you would want to do an annuity instead of just direct market investing. Okay, so before you buy any annuity, ask three simple questions. Okay, three simple questions. What are the fees? Okay, are there any fees? Are there some fees? Okay. What's guaranteed? Okay. My principal guaranteed or not? Right. What's the surrender schedule? Okay. Was there a surrender schedule tied to this? 1 year, 3 year, 5 years? How long does the surrender schedule ask? Get those clear answers and make sure you understand that, or you should just walk away. Okay. If someone can't provide those clear answers that I just provided, you do not need to be, putting an annuity in your portfolio. Okay, here's some quick historical facts about annuities in the United States. Way back in the 1790s, Ben Franklin, he left money in his will to fund annuities for Boston and Philadelphia, supporting apprenticeships and civic projects for over 200 years. Check that out. All right. First U.S. annuity provider was in 1812. That was the Pennsylvania Company for Insurance on Lives and Granting Annuities, became the nation's earliest issuer, offering contracts to provide guaranteed income for widows and families. All right. Here's a couple more. ERISA boosted annuity popularity in 1974. And the Employee Retirement Income Security Act encouraged employers to use annuities to provide guaranteed retirement income, expanding the market nationwide. That was in 74. Then in 1995, that's when the fixed index annuities arrived, and FIAs introduced a new option by combining principal protection with market-linked growth. And these quickly became one of the fastest growing retirement products that are in our nation today. All right. So smart vision for you, as you look towards retirement and you cast the vision, you put your daily mission in place. What will retirement look like in your future? Okay. You're planning, as we've said, oftentimes you need to plan potentially for a 30-year retirement. Okay. A clear vision now with goals attached to them, and as you are planning towards this, you want these, this vision put on paper. You want this mission of your dream retirement mapped out. Okay. Statistically, 37% of Americans feel they need more education or retirement planning. I understand. So 4 out of 10 need that education. This is why we're here. One of the reasons why we're here to provide that. 5 out of 10 or 52% of Americans wish they had more education on how to invest. Okay. This is once again why we recommend to sit down with you, your spouse, your family, your business partners, consider how you're going to plan into your golden years on things like Social Security. Okay. When are you taking Social Security and why? Okay. You have to have a plan on when you're going to take Social Security. Okay. How about taxes? Is your tax bracket going to be lower in retirement, the same in retirement, or higher? Okay. Have a lot of clients that are making more money in retirement than they were when they were working. How in the world could that happen? Because the streams of income have been set up and structured to pay them an even more of an amount than they had while they were working. Okay, that takes planning. All right. What else? Medicare. Some retirees assume that Medicare covers everything, from hospital stays to regular, doctor visits, even long-term care. It's not the case. Okay. Basic Medicare plans cover hospital stays and physician visits. Okay. You can add prescription drug coverage, but there is no long-term care add-on for Medicare. Let me say that again. Long-term care is not covered by Medicare. Okay. You've got to do some retirement planning for that. As you get older, 1 out of 2 in the state of Maryland over the age of 74 are going to experience some type of long-term care need. Those statistics vary, those ages vary, but more than likely, you're going to, put some money towards long-term care. Think about it. A mother, father, aunt, uncle, your grandmother, somebody in your family you might be taking care of now. And we all know, and you can agree with me, that is very expensive. So you want to factor that into your retirement planning. Also, life expectancy. Okay. You're going to get hit by a bus at 62 and you retired at 62. Yeah, you need to take Social Security at 62. Okay. Just joking. When do you think you are going to die? No, we don't have a crystal ball, but how old is your mom? How old is your dad? What kind of health are you in? Okay. You want to plan out, some type of, planning as it relates to how healthy you are, because if you live to 100 years old, your life expectancy, if you retired at 65, you might have more retirement years than you had working years. So as smart vision related to retirement, a smart way to plan in all these features is to sit down with someone, do a complimentary consultation with us, do a overall retirement plan with us, taking off the table longevity risk, Medicare risk, Social Security risk, your income planning risk. You want all these risks taken off the table years, hopefully, before you retire. Okay. Now, if you're retiring this year, you definitely need to sit down with someone to make sure your retirement planning, your retirement income plan is protected, that you have confidence that you're going to, stay on track. Okay. And if these shows are helping you, right? And specifically today, if this show is helping you and has helped you, annuities, they're not really confusing. They're not products that you want to avoid getting the education on. It's a practical tool that can really strengthen your retirement, right? You're already ahead of the game because you're listening. You're already ahead of the game because you've done, a little bit of planning, but with the right mix of guarantees, with the right mix of growth potential, with the right mix of professional guidance, you can create a retirement plan that's built to last through any of these market cycles. Any other volatility, up or down, you can have a plan that takes all that risk off the table. Schedule that no obligation retirement income review with us today. You know how to get in touch with us at 301-242-3950. Our website, www.retirementincome4life.com. Help us help you build that confidence. Help us help you with the clarity you need, with your vision and your daily mission as you're moving towards retirement. Also, don't forget, we do have a free resource, retirement income. We have a retirement income survival kit for you that you can download absolutely free. And once again, we look forward to helping you with all of your retirement income planning needs. Stay protected, stay the course, stay confident, get that wisdom you need related to annuities. Do not hesitate. Reach out to us today. We look forward to helping you with all of your retirement planning needs.